All right, hi everyone. Welcome to today's webinar provided by Solarplaza and TCX, held in preparation for our upcoming Unlocking Solar Capital Africa conference, which will be held on the 1st and the 2nd of November in Nairobi. Today's currency-focused webinar is organized together with one of our sponsors of the event, TCX, and will be joined by Persistent Energy Capital, GuarantCo and MFX, discussing some of the key issues on the event. Currency risk is consistently mentioned as a key risk for off-grid developers and now also increasingly for on-grid projects. And in this webinar, we will try to address the issues around currency risk, the impact of volatility on the different actors in the energy sector, and solutions and some concrete structural issues to bear in mind. At the end, it's a difficult subject, so at the end we will be sure to have plenty of time for a Q&A, so if you have questions, don't hesitate to ask them. The Unlocking Solar Capital Conference will be a two-day event focusing on unlocking capital for new solar project development in Africa. We will welcome over 300 international stakeholders ranging from financiers to project developers, IPPs and EPCs and more. The conference will focus on the three main solar electrification segments, on-grid, mini-grid and solar household systems, each in a dedicated track and has a strong investor focus. We will be discussing topics that are relevant to the development of each segment. At the moment, our site is updated daily with new speakers, a few of which are shown here. If you find this webinar interesting and useful, be sure to check out the website. Just to give you a taste or a preview of who will be there, this is an overview of the attendees so far. A quick reminder that our early bird deadline expires tomorrow, so don't hesitate to register online if you want to profit from that. Quickly about Solarplaza. Solarplaza is an international information and business development platform that is focusing on the global solar PV market. Our core business are events and trade missions. We've been around since 2004 and have by now organized over 80 events in both established and emerging solar PV markets. Now, just before we start, I would like to point out some practical things. If you have any questions or issues during the webinar, you can communicate with us by typing in the control panel on your right-hand side where it says questions. Questions directed at the presenters will be collected and we will aim to get everything answered in our Q&A session at the end. Now, I will briefly introduce our four speakers of today. There are four speakers that each play different roles in the effort to support sustainable local currency funding solutions for the energy sector. The energy sector is typically a local currency generating industry, so quite an important topic. We will start with Dirk Munch. He is Managing Director of Persistent Energy Capital, and he will kick off and offer the industry practitioner's point of view. Persistent Energy Capital is an energy advisory boutique and investor with insider knowledge of the currency issues faced by developers. Then we will have TCX Fund, who is represented by the Senior Vice President Per van Zwaay. TCX is an Amsterdam-based development initiative that offers hedging products in developing markets where financial markets fall short. Then Douglas Bennett is the COO of GuarantCo, which is a development initiative based in London that can support local currency funding from domestic sources through a series of guarantee and credit enhancement products. And our last speaker will be Brian Cox, President and CEO of MFX Solutions. MFX is a hedge intermediary vehicle that is closely aligned with TCX, and they offer the possibility to lenders and developers to procure hedges without collateral requirements. And then, without further delay, I will have to give the presentation to Dirk Munch. Dirk, the floor is yours.
Thank you very much, and welcome everyone. It's a pleasure to have a chance to speak to you about one of the most important issues we see right now for the off-grid energy sector, and that is the issue of FX risk. Let me try to move to the next slide. Here we go. Briefly about persistent energy capital and our experience. We have been focused on the distributed off-grid energy services, or PAGO sector as it's often called, since its very early days, since 2011, 2012. Since then, Persistent Energy Capital has made 10 investments in the sector and its value chain. We invest our own capital and we invest third-party capital. That is, we manage funds in this sector. PEC is also acting as an advisor to companies and other investors in the space. Most prominently, we structured and arranged the first solar asset receivable-backed note in Kenya and for the sector in general in late 2015, together with eBox and OECO Credit. And we provide FX advisory services to companies in the space. We also do consultancy work for the World Bank and similar institutions. Very briefly, I would like to say that a distributed energy services company for us is a company which provides private households and small businesses with an energy asset and enables the customer to pay for that asset over time. This is a very general definition, and it includes companies that provide solar home systems, but also companies that install microgrids and connect their customers to these microgrids. So DESCO is for us the overarching expression for a company that serves off-grid customers. And this is in contrast to power projects that have a PPA and provide services to institutions or even countries. This also has as a consequence that DESCO's revenues are always in local currencies, as they are receiving their revenues from households and small businesses, and therefore these are in local currencies. In consequence, DESCOs are heavily exposed to local currency devaluation and currency shocks. Consider the balance sheet of a typical DESCO that everyone probably knows, like Mcopa or Mobisol, but it could also be a microgrid company like PowerHive or even Devigy. The largest assets of these companies are customer receivables, and most of the time, or in nearly all the cases, these payments are in local currencies and can be up to 3 years in the future. The companies also have a very limited ability to adjust these payments once they have signed up a customer to inflation. That means the payment plan is basically fixed at the very start. And it is impractical for these companies, or not in their commercial interest, to transfer the FX risk that they are facing to their customers, as those customers are really generally not in a position to carry such a risk. At the same time, their largest liability is either a US dollar loan or a euro loan or hard currency equity. Accordingly, DESCOs have a significant mismatch between their assets, local currency receivables, and their main liabilities, hard currency loans or equity. And this is really where the exposure to local currency originates from. So if we consider for a second the typical balance sheet of a DESCO, and it will be difficult to go into great detail here given the limited time we have, but if we consider it just from a high level, on this slide I have two different balance sheets of basically the same company. You will see that the major asset on these balance sheets is the local currency denominated receivable. And in the first case, at the top, there is no liability in local currency that would balance such a receivable. and therefore the company ends up with a net currency position of about $6.5 million. In the second scenario, it's the same company, it has the same asset, but this time the company has borrowed in local currency and is therefore balancing the local currency asset, the receivables, with a local currency loan, and as a result is only exposed to, its net position is only about $1 million or $875,000. Accordingly, if you imagine a currency devaluation of 10%, which in emerging markets is really nothing that's out of the ordinary, in scenario A, the company would lose about $650,000, or would have a P&L effect of that size. In the second scenario, it would be closer to $80,000, given that the asset loses value, but at the same time the liability loses value too. So in consequence, if you lend in local currency, the goal should be to also borrow in local currency in order to not create a net currency exposure. Companies can achieve that by, as I mentioned, borrowing locally. They could also achieve a balanced by selling the local currency asset. For example, in a securitization, as we have done for B-Box last year, they could remove a local currency asset from the balance sheet. Finally, they could also enter into a derivative transaction which would effectively replicate the effect of a local currency loan. Now, the problem often is that local markets aren't very deep, and it's very difficult for companies operating in these markets to borrow locally. And there are a few options for companies to borrow in local currency without local lenders. And basically, the first one would be that an offshore lender offers the company a local currency denominated loan and swaps the local currency payment with a specialized counterparty such as TCX or MFX into a hard currency cash flow. The second option would be that the offshore lender offers a US dollar denominated loan with a local bank, and the borrower or the DESCO effectively borrows in local currency from the bank that now has the US dollar loan as a guarantee. And finally, there's also, of course, the option that the US dollar denominated lender offers a loan, and the borrower itself enters into a hedge with a counterparty such as TCX and MFX again. And to conclude this short presentation, the main point to take away here is that by definition, DESCOs who serve off-grid customers will end up with a long local currency position. They lose value, or they have a negative P&L effect whenever the local currency loses value. In my view, and I say that as a former trader of emerging market currencies, DESCOs should not risk it. In contrast, DESCOs should try to borrow in local currency and somehow match the local currency assets, or move those local currency assets from the balance sheet through means of a securitization or similar. While local debt markets are the most logical source, and GuarantCo will comment on this further, while they are the most logical source, they are very often not readily available. And while many people perceive the cost of borrowing in local currency as very high, it's important to note that a very high interest rate is not necessarily an indication of the cost of the loan, and TCX will speak about that aspect. And finally, if local debt markets aren't sufficiently available, which still may be the case for some time, we recommend that borrowers and lenders work together with hedge providers such as TCX and MFX in order to find solutions based on derivatives. And in general, we believe it is very important that DESCOs and their equity investors need to build the capacity to measure and mitigate their currency risk. And lenders, in particular, should develop capacity to lend to the sector in local currency. And with that, I pass on to the next speaker. Per. Thank you very much.
Thank you very much, Dirk. Yes, so let me take that further, and I think I would like to spend a bit of time especially on the last point that Dirk mentions with regard to the perceived cost of hedging, some issues around that. But to start off, a very brief introduction of TCX. For those who are not familiar with the fund, TCX has been around for nearly 10 years now, and we were created by the development finance community with the specific mandate to develop derivative hedge markets, in turn with the objective of supporting local currency funding to borrowers that have local currency assets and revenues. And we do this in developing countries, so typically in markets where hedge markets are otherwise non-existent or very shallow, meaning that they are difficult to access for everybody but the premier credits in a country. We do this on a global scale. We have transacted over $4 billion of transactions in 70 currencies. Our whole model is predicated on having a globally diversified portfolio, and our model is very much to work together with, first of all, of course, all these shareholders that are depicted in that diagram, but also with commercial banks. We definitely do not want to compete with commercial banks. We want our product offering to be additional to what the banks can do, and where possible we like to cooperate. And we also cooperate closely with other institutions that not coincidentally happen to be on the call, like MFX, as Brian will explain later, is a close partner of ours, but also GuarantCo. We all share the same mandate of making local currency solutions available to ensure sustainable financing and build sound businesses. So trying to, okay, so first of all, to demonstrate volatility, what this graph shows you, arbitrarily I've limited it to Africa, but it shows for the most frequently quoted African currencies what over the last 3 years has been the annual average depreciation. So what this graph tells you is how significant average depreciations can be over a 3-year period. What it does not yet show you is the very often very high daily monthly volatility. So whilst this shows you the absolute magnitude of depreciation, it doesn't show you yet how highly volatile currency movements are. You will see for Africa, most currencies have depreciated at least 10% per annum, while some currencies have depreciated in a 3-year period on average 30% per annum, and the most significant two are here, Mozambique and Nigeria in the middle, close to 35 and close to 50% even for the Metikai. The main point being here that you should see these levels in the context of hedge rates, and we'll talk about it in a second, and you may have an idea of what these are, local currency borrowing rates or hedge rates. very often 10, 15, even 20% being perceived as expensive. Those rates need to be seen in the context of these kind of absolute depreciations on an annual basis. One quick comment on the on-grid situation, not to be overlooked. Dirk is very much focusing on the DESCOs, so the direct exposure, that's where his focus is, but the on-grid structures also suffer greatly from the just described. The typical on-grid PPA model is that where IPPs build projects on the basis of a dollar PPA, transferring exchange rate risk to the utility, and it's then the utility's decision to either bear that risk and to transfer it to its government and ultimately to taxpayers and even further again to donors, to the extent that they have to step in for government finances or utility support, or they are obliged to or choose to transfer exchange rate risk to consumers by increasing tariffs. And in this model, neither the project nor the lenders are typically too concerned about the exchange rate risk because it's borne by the utility, very often backed up by a sovereign guarantee. The point that we would like to make is that while that model has been solid and reliable for the last 20 years, it has always been suboptimal because you're transferring this risk to other actors who are not very well positioned to bear this risk. But as of today, I think you can credibly make the point that that model is also becoming less and less reliable, because as the installed capacity in many, let's say, African currencies, to focus on those for a minute, installed capacities are rapidly being increased, and if you continue to develop those projects with the exchange rate risk being imposed on the utility and other domestic actors, you have to start thinking about the utilities and even the government's ability to continue to shore up their obligations under the PPA. And the point that we have been making is that while it is very difficult to start changing local dollar PPAs into local currency PPAs and thereby disrupting this whole model that everybody has gotten accustomed to, a good intermediary solution is to start working with utilities directly to start hedging some of their currency mismatches that they are exposed to under their dollar PPAs. And this is something that we have been starting to discuss with a number of African utilities. We believe that there's a lot of potential. There's some structural issues associated with that. One of them is how to deal with the credit risk, the counterparty credit risk that we then face on utilities. And we're talking to different institutions, such as also GuarantCo, on them potentially shielding some credit risk while we take the market risk. So this is something that is under exploration. Ultimately, of course, the end goal is that, and you see this in more liquid markets, more developed markets, that governments will start to insist on having local currency PPAs, especially in countries where local currency markets are much more liquid and deep, and hedge markets more available. That starts to make a lot of sense. But in the meantime, working with utilities to hedge exchange rate risk at that level is a sensible approach. The general question, whether you're talking about hedging utilities or about DESCOs needing to avoid currency mismatches, is of course the assertion or the belief that hedging and or funding in local currency is expensive. What we would say is that what this image says is that that is potentially a misleading thought. While it's well understood why it is the case, nominal interest rates in local currency are much higher than dollar rates, so it's easy to understand why this perception exists. But we would say that the statement that hedging or local currency funding is expensive is equally unfounded as the belief that dollar funding is cheap. So I'd like to explore those statements a little bit further. In principle, is the key message is that in principle, if you are at the point that you are going to decide to hedge, in theory, when it comes to the financial cost of taking out a hedge or taking out local currency funding as opposed to dollar funding, in theory, your expectation should be that they are equally expensive. To elaborate, if you look at the hedged option or the local currency borrowing option, your expectation is you know that you are going to pay a higher nominal local currency interest rate. You may be paying 15% as an interest rate, for example. On top of that, what you should expect is that somewhere, if it is a hedged instrument, if you are taking out a local currency loan from an offshore lender and you know that that lender is hedging with someone like TCX, or you're doing the hedge yourself, you borrow dollars and you hedge yourself, you should expect to be paying a hedge premium to that hedge provider. However, if you compare that to the dollar option, and we're assuming, of course, that we are dealing with a party that is earning local currency revenue. If you look at the unhedged or the dollar option, it's true that your nominal dollar interest rates will be lower, but however, you must immediately add to those nominal interest rates the cost of annual depreciation that you can reasonably expect of the currency concerned to experience. If you're taking out a 3% loan in Kenyan shilling, and your reasonable assumption is that the currency will depreciate by 8% per annum, you immediately have to add that to, let's say, your 5% cost of borrowing in dollars. So you're already at 13%, not 5%. And on top of that, you must add the expected premia that you should be paying, will be paying, to your lenders and other credit suppliers. You are now, with dollar funding, if that's a substantial portion of your balance sheet, you are running a substantial currency risk, and lenders and other credit providers will penalize you for that by requiring a higher credit risk premium. So as you can see here, in expectation, both options should be equally expensive. While if you take out the local currency option, the hedged option, you are, of course, no longer exposed to daily volatility and daily uncertainty, and you are no longer exposed to a possible shock event, which possibly might exceed by a long shot the annual average depreciation that you modeled. If the currency, for whatever crisis, external or internal, depreciates, has a shock devaluation of 30%, it doesn't affect you at all. So if you see this and if you embrace it, then hedging in a way is a no-brainer. You should always do that. This model, this assertion in this graph, is actually backed up by TCX's own model. We've been closing hedge transactions for 10 years and, as I said, close to $4 billion equivalent, and on average our hedges prove to be cost neutral, meaning that we are not making any. That means that the flip side of that is that our counterparties are not making a gain or a loss. In other words, their hedging is indeed cost neutral on a portfolio averaged out basis. Now, if you look at, as to further give you some color on that claim I just made, if you look at now the same African currencies we showed earlier, so the red column here for all these currencies is the average annual depreciation over the last 3 years. What we have added is the gray column, which is the 3-year fixed hedge rate that TCX could offer precisely 3 years ago. And then the yellow column is what the hedge, purely from a financial gain or loss point of view, would have what the impact would have been. So would the hedge have made or lost money? We do not believe that that is a good way to look at the hedge per se, but it is of course important to understand how much the hedge cost in inverted commas may be. And what you will see is that in this particular period of time, that, and we admit it's a little bit arbitrary, but it's also, we haven't deliberately chosen this range. It just happens to be the past 3 years in the case of Africa. And what you will see is that actually only in the case of Ethiopia, which is ETB, and Kenyan shilling, KAS, you would have, the hedge would have cost you money. In the cases of all other currencies, had you hedged 3 years ago, you would have made a financial gain on that hedge. Again, the point is not here to argue that a hedge will make you money. Clearly not. If you would look at the same analysis, for instance, for Latin America and Asia, you would see a much more balanced picture. So African currencies have had a very rough time over the past 3 years. The point only that we want to make is that we want to dispel this notion, this idea, which we believe is false and misleading potentially, that hedging is costly. That is simply not a true statement. A bit further on the principle of hedging. So having made the point that it can move both ways, it can be positive or it can be negative, that is very clear. But on average, it turns out to be neutral. But that's important knowledge. But the way to look at the hedging, of course, is it eliminates volatility, it eliminates chance, it eliminates exposure to serious shocks. If you assume this as a possible image of currency depreciation for a certain currency, 1 year it's 10, the other year it's 20, etc., etc. If you are unhedged, this volatility will have a one-on-one impact on your profit and loss and on your cash availability, on your cash flow. Whereas if you hedge and you lock in a local currency cost of funding at a certain level, which may be 15 or 16 or 14, whatever it is, what you're doing is you're eliminating all volatility and all risk. And whether that hedge means that at some point you may make a minus or a plus really is secondary, once you understand, of course, that on average it should not be a substantial cost nor a substantial gain. But the issue is, if you are a business and you don't want to speculate on a currency, and you also understand that hedge rates are not necessarily more costly or cheaper than dollars, it's sort of even out, then you should choose the green line, in other words, hedge or borrow in local currency. So to summarize, yes, if you look at if you look at local currency, yes, normal interest rates are much higher often, and it can be very deterring. And you may also think, well, I might pay these high hedge rates, but these rates might in the end turn out to be higher than the exchange rate loss I avoid. So for me that is a cost and a reason not to hedge. And then you might also think, well, even if I don't hedge and even if our currency tanks tanks badly, then what I can always do is increase my prices if I get unlucky and pass it on to my consumers. So that might be your conclusion. That might be a conclusion to not hedge or to borrow in dollars. However, the balancing arguments, of course, are that the cost of hedging, you should factor in the avoided annual depreciation, so that already eats into the perceived cost of hedging. If you hedge, you are fully protected against anything substantial happening to the currency. You have stable debt servicing costs, you have a predictable profit and loss, you have much better ability to budget for future events. But also, you now don't have any need to increase consumer prices because of forex issues, which allows you to offer much more stable terms to consumers. And also it's important to note that if you are not exposed to currency risk, that should allow you to negotiate better credit terms with your lenders. It should also, including the ability to leverage more and thereby offering better equity returns to your investors. And finally, of course, it saves you a lot of managerial stress, and you can focus much more on your business if you don't have to be worried about how the currency performs. And in the end, your conclusion should probably always be that if you have the ability at sound hedge conditions to hedge or to borrow in local currency. I will skip that slide in the interest of time and hand over to Douglas at GuarantCo.
Hi everyone, thank you. Let me see if this is working. Sorry, I don't seem to be able to. Evelyn, sorry, I don't seem to be able to move on with the slides.
Yeah, can you click on the screen itself and then see if you can actually move it with the mouse boards? Or click with your mouse? Voilà.
Okay.
Perfect.
Okay, thanks. All right, everyone. So GuarantCo has been sorry, it doesn't seem. Sorry, Evelyn, it's gone again.
Just let me know when you need to move slides and I will do it.
Okay, can you move on to the next slide, please? Sorry, everyone. So GuarantCo was set up by various, mainly European governments, and includes now Australia, to try and help the financing of infrastructure in lower income countries. And we do that by supporting and crowding in the local banks and financial institutions through the use of mainly guarantee products, with the aim to sort of bridge the gap between what the project or the company requires for its funding and what the local market can do. The ultimate aim of GuarantCo is to do ourselves out of business by building complete self-sufficiency within the local markets, and that's obviously quite challenging and will take a number of years. Behind GuarantCo, and what allows us to do this, is the strong ratings that we have, as indicated there, AA- from Fitch, A1 from Moody's. Bloomfield operates in the Francophone regions and AAA, and we recently had a rating in Pakistan because we can operate outside of Sub-Saharan Africa as well, in Asia and other low-income countries. Next slide, please. So local financing, what I really want to give people a takeaway from this is local financing can be an option, but is often ignored. A good example of this is what's happened in Egypt recently. For those who know Egypt, there has been a phase 1 of a big 2 gigawatt solar project there, which unfortunately, hasn't been successful in the first phase for a number of reasons. And one of the reasons was the tariff there was set so that 85% was pegged to the USD, but all was payable in Egyptian pounds. Because it was payable in Egyptian pounds, the local banks could only provide Egyptian debt to that, and they were able to provide up to 15 years and at quite material amounts. Not enough to provide the whole financing required for the phase 1, but could have been significant. So it was really set up there to support dollar debt coming in. Fortunately, with everything that's going on with Egypt and issues shared with other countries in Sub-Saharan Africa as well, convertibility and the availability of dollars and the transfer of those outside of the country became a particular issue. So one of the reasons for the lack of success in the phase 1 has been all these issues, and that's been set by partly ignoring the local market and what is available there. And hence what sort of GuarantCo has been set up is to try and make best use of the local market, although it won't be the complete solution for everything. So, to look very quickly and briefly of what is possible for the larger sort of IPP type projects. Not for the largest, but for sort of the medium size, it's certainly possible for those to be financed in local currency in some of the countries. Egypt's example, Kenya, others of the larger, more liquid countries. The tariff, unfortunately, outside of South Africa, tends to always be put into dollars. That you would need either a split tariff, so one that maybe still gave a dollar return for equity, who might be interested in seeking a dollar return, but still allowed for the the local currency debt to be passed through on the tariff. We are looking to do this in a couple of countries at the moment where we could provide for this split tariff. One of the issues, though, related to perhaps the sort of longer-term project financing is the sort of tenors required. But as indicated, in some countries you can go up to 15 years. There can be help to extend the tenors as well to get from what the banks are quite comfortable with, say 5-7 years in local currency, to get them up to sort of 12-15 years that might be required. But it does require a certain level of understanding of cash flow-based financing, which is not always prevalent within some of the local banks. And again, this is one of the reasons why GuarantCo was set up to try and support that. Another way of financing is to do it as a corporate financing, and we often see this really with local conglomerates who are perhaps adding on a power project for their own use, but with the ability to sell the surplus into the system. This is a non-balance sheet financing. It can be easier for local banks to understand this. They will have a long-standing relationship with the corporate, but the corporates will have to take the burden of that on its balance sheet, which might be better, though, than dealing with an IPP type product. Other options, perhaps, sorry, next slide, please. Other options are also available, perhaps for the smaller solar home solution companies, and we're looking at a few of these at the moment. Quite often you split the inventory financing from perhaps the receivables financing for those, and for the inventory financing you can get the local banks to provide letters of credit for the importation of equipment, etc., for example. Again, you can do more of a corporate financing for, say, the solar home solution company. This can be discounting the receivables that they provide. So a local bank, for example, may buy the loans off the solar home solution company at sort of 70-80% of the value of the loan itself, and will provide that funding directly to the solar home solution company itself. Those loans can then be warehoused, and they can then be packaged potentially for a secondary sale, which is where you might get the capital markets involved. The local capital markets are a possibility in some countries, not all, and they tend to be the cheapest form of long-term debt. Not that necessarily the loans that are being provided are that long, and therefore the bonds to refinance those needs to be so long either. But if you take East Africa, for example, in Kenya in particular, the capital markets is a distinct possibility, and we're looking at supporting a few companies with that. The other way of doing it is actually not to necessarily lend to the solar home solution company itself, but to actually, for that company to facilitate the loan to a customer directly, but for the loan to be provided by the bank. Which really brings me on to some of the other sort of additional benefits that may come by dealing with the local markets, and that is really the partnership approach that can happen with that way. Quite often we see one of the benefits is the sharing of the analytics, the sharing of the credit information that may be both within the solar home solution company as well as within the bank itself to allow for better credit decisions, which in turn will allow hopefully for more efficient funding to the benefit of the consumer and to the benefit of all the stakeholders as well. Now, this was a very quick run through, given the time. It's also, as mentioned, this is feasible in some countries. it is not feasible necessarily in all countries that is out there, and therefore at times you have to look for other options, and Brian will be perhaps discussing some of those in his talk, which is coming up now. Thanks, Evelyn.
Okay, okay, fair enough. Yeah.
All right, Brian, the floor is yours.
Okay, thanks, Doug. Here, let me see if mine is. I may have to make the same request to advance the slides. You go. There we go. So, Doug, yeah, that was really a perfect setup, and I know we're running a little late, and I want to make sure people have time for questions. So I'll try and run through this fairly quickly. Dirk, I think, presented the kind of the three options if you're convinced by Pear's arguments that taking currency risk is too risky if you're really in the solar business and not in the currency speculation business. But you can borrow in local currency locally. You can borrow in local currency from an international lender if you can find it, or you can borrow in hard currency and try and hedge the risk yourself. So I think Doug talked about some of the challenges and opportunities for the first one of those, which is borrowing locally. MFX was set up about 8 years ago to help make hedging easier for lenders and borrowers who are operating with international funds flowing into local markets. MFX is a market intermediary, so what we're doing is we're taking risk off of our clients and then taking that market risk and offloading it to other partners, TCX being our main partner. We offload about half of our risk to TCX. The other half goes to different international banks. The biggest advantage that MFX can offer, and what we were really set up to do, is to intermediate credit risk for clients who are trying to hedge. And maybe you can go to the next slide. I'll explain what that is. So this just sort of shows the flow of risks in a transaction. If you're a DESCO, or if you're an on-grid project, you're taking business risk, and very much as Per pointed out, you're also taking market risk. So when you decide you want to get rid of the market risk, that you want to keep your business risk, but you want to get rid of your market risk, then you're gonna face a hedging counterparty. But a hedge always involves an obligation for payment in the future, and as such, that introduces credit risk into the equation. So normally, when you're going into a hedge with a bank or with TCX, if you were hedging with them directly, the way that your credit risk to them would be handled is through collateral. So they would require you to put up cash up front to cover the chance that the swap would be against you and that you could default on that future obligation. And then as the value of the swap moves, that obligation, you would have to put up potentially more cash to cover the change in the value of the swap. So what that means is, for impact investors, that you may have to put up as much as 30% of the value of your loan on the sidelines to be able to fund that credit piece of the swap. And what MFX was set up was sort of with the realization that was, especially for impact investment, that was too big of a burden for a lot of the lenders and borrowers that needed to hedge. So MFX, as you can see on this, diverts the credit risk, and we don't hold it, but we offload it to DFI partners that we have. So OPIC, and also we have guarantees with FMO, the Dutch Development Bank, and basically what they provide us with guarantees on the credit risk of our clients, who have to be qualified as impact investors. And that allows us that gives us the credit standing to trade without collateral to our partners, TCX and the banks, So we can send them our market risk without having to deal with collateral, and that means our clients don't have to deal with collateral either. It ends up being a really important advantage. So if you can go to the next slide. Just in a very practical sense, I want to just show a couple of structures because we can't do it under every structure. But I want to just highlight a few structures where we can do it, so that you as investors and borrowers can kind of think about how to structure your deals. So this structure would be with an impact investment fund who's lending to a DESCO, or could be to a solar project that then obviously has local currency. So in this case, if you're the borrower, you don't have to worry about the hedge. You're getting local currency, but from an international lender. And a few months ago we did a deal like this. You can put in for funds the responsibility energy access fund, and was making a loan to MCOPA, and they got it in local currency. Responsibility hedged the risk with MFX, and then we sent the risk, the market risk, on to TCX, I think, in that case. Can you go to the next slide, please? So in some cases, though, as a borrower, you're not going to be able to get local currency from your lender. And OPIC is a good example of this. They're very active in the DESCO market, and also are funding some PPA projects. But they only lend in dollars. But what we have, though, is with these kinds of lenders, we're able to do a collateral-free hedge directly with you, with the borrower. And we have some special, because OPIC is also our guarantor, we have kind of a special mechanism with them that involves a little bit of a change in the loan agreement that gives us seniority in the loan. That gives us that makes essentially the credit of our counterparty, who's the borrower, meets our standards, and we can do it without collateral. Next slide. So the final one would be if you have a commercial, if you're borrowing from a commercial lender that can only offer dollars, we structure with either a guarantee from the lender or the seniority mechanism. We also potentially can do the swap without collateral. We can also look at a more of a collateralized structure. So if you're looking at external sources of financing, the most important message here is really look for the structures that are going to be able to allow you to mitigate your currency risk. And there's several available, and we certainly can work with you on and with your lenders on how to structure those. But there never should really be a reason that you have to that a project has to take on the currency mismatch that Per described. And I'll just end on one last slide. I think a question that comes up is, why would we use an intermediary if we could hedge directly with some of the counterparties we trade with? MFX, we have a very transparent sort of business structure. We add a fixed spread to our cost of hedging. When we're hedging with TCX, because we're an investor in TCX, we actually get a better price than an external party would. So the pricing of hedging through us versus hedging directly with TCX is basically the same, plus you get the collateral advantage. Likewise with banks, unless you're able to deal with a local bank, in which case you may be able to get lower cost financing, and that's certainly something to look for, including using GuarantCo's structures. But for international banks, because we have this AAA backing, we may be able to help you get better pricing. And in any case, the opportunity cost of having to put collateral can also make a big difference. So let me stop there so we at least have a few minutes for questions.
All right. Thanks everyone for a very in-depth and comprehensive insight into all aspects of local currency funding solutions and currency risk. So we're moving to the Q&A. All the attendees, be sure to keep typing your questions on the right-hand side in the chat box. We are almost at our time, but we will continue a bit further into Q&A. Everything will be recorded, so if you have to jump off, you won't miss anything because you will be sent the recordings. I will unmute all panelists. So if you want to answer or add to a specific question, you are very free to speak. And so we already have some questions coming in. Specific one for TCX. Taking the assumption that you will have a PPA in local currency and the currency risk could be covered over the debt tenor, have you been able to estimate what could be the increase on the PPA tariff? And then it actually continues, in a sound energy sector, the PPA tariff should be passed through in the end user tariff. Is that socially or politically acceptable? Fair.
Okay, well, thanks for the question. The way I understand the question is if you assuming that you can do local currency PPAs for, let's say, 15 years, can you pass on, or what is the impact on the tariff, and can you pass it on? What is clear is that if you start today with a local currency PPA, the funding of the IPP will naturally also be in local currency, and that funding will come in at a higher nominal interest rates compared to the dollar funding. So with the dollar PPA and dollar funding, let's assume that the dollar funding would be 5%. With the local currency PPA and local currency funding, let's assume that the local currency funding comes in at an all-in cost of 20%, so including the credit margin of the lenders. The point is that whilst that seems, again, it's the same thing that we said earlier, whilst that seems 15% more expensive, the actual cost of the dollar alternative is not going to be 5%. It will be potentially 18% or 70% or 60%. That depends on your assumptions around depreciation and how they actually turn out to be. And it also depends on how the lenders in question assess the additional credit risk because of, well, that's not true. We're talking about a match situation, so they would not bear that credit risk in this case. But so the main difference is that 20% in local currency, 5% in dollars. To a large extent, the difference between those two rates will disappear if you factor in the average expected annual depreciation plus the eventuality of currency shocks. The passing on of the necessarily higher tariff because of dollar or local currency funding is completely justifiable and you know, the right thing to do, because while it may initially look like a higher required tariff that consumers must pay, they will not in the years following the commencement of the project, assuming that one project would dictate the consumer tariff, which is of course not the case. There's multiple projects which have a role in there, but if you would have this one project supplying the entire country, the fact that they are now paying an initially higher tariff to support a higher local currency interest rate on the debt funding of the project is justifiable, because they are no longer exposed to otherwise to be expected currency volatility if it was a dollar project, because then if the currency depreciates, and again if you assume, depending on what your assumptions are, but as we pointed out, a 10% depreciation in sub-Saharan African currencies is the minimum that you should expect, depending of course from currency to currency. So over a longer period of time, they will be they should expect to have at least a similar cost for electricity if it's a dollar-based project. That's one. But secondly, and maybe more importantly, if it's a local currency project with local currency funding rates, for sure they should expect a much more reliable tariff because the currency volatility does not have to be factored in to the tariff. And if you take a country like Kenya, but also Uganda, what they have done is they have adopted an automated tariff adjustment mechanism, and you can see it in your monthly electricity statement. Every time that the currency depreciates, it is immediately factored into the tariff. From the utilities point of view, that is seen as a solution to the problem because they now have a mechanism to offload currency risks that is transferred to them under the dollar PPAs to the public. But for the public, it's not a solution at all because it means that they're exposed to precisely that currency volatility that we were describing earlier, which is an unknown in terms of absolute volume over time. But it's certainly also an unknown in terms of when do the increases of tariff come and with what magnitude. So we would argue that the consumers are definitely better off with a energy sector that is funded in local currency.
All right, that is clear. I have a specific question for Douglas from GuarantCo. Have you had much success with securitization schemes in Africa? And could you walk us through an example? Who's buying the paper?
Not in Africa as yet. We're looking at a few in Kenya where these will be privately placed to begin with. I mean, one of these will be privately placed to Kenyan investors who will be looking for this. What we know through the market that there is interest for a certain amount. I mean, I don't want to sort of give people the idea that this is a hugely liquid market, but it needs to start somewhere. And certainly, you know, of the ranges of a few tens of millions, this is possible in Kenyan shillings, for example, but wouldn't necessarily be possible in Uganda or elsewhere. But a lot of times you just need to start somewhere and show what can be done, and hopefully, you know, take that further in other countries, and you know, on the back of the demonstration effect of doing it in Kenya, for example.
All right, thanks, Douglas. Brian, and also Per, if you would like to perhaps comment, what are the minimum transaction sizes you can do?
We can do basically whatever we can get in the market. So we've done transactions, you know, as low as $100,000, even less at times. TCX tends to have a little bit higher minimums, about 250,000 for forwards and 500,000 for swaps. But you know, we definitely do work with, you know, small players on small transaction sizes. Per, do you have anything to add?
I can. What Brian says, I confirm, of course. So downside, we are a development finance initiative. Well, but of course we need to be practical about the volumes that we can deal with to keep our operations sustainable. But you know, our primary interest is to help people out who are faced with the currency mismatch that they otherwise cannot mitigate. So definitely available to look at small transactions. Also, our maximum size, should also mention perhaps, is around 50 million on a single transaction basis.
All right, and I think a more general question. You are all recommending to hedge as much as possible on the project. However, for most of them, the funding required is in hundreds of millions of dollars. Can the market provide such coverage, and are we not advocating for a partial hedge in most cases? Who feels that he can answer?
I'm sure we all can. I guess we just.
Yeah, I mean, I'm happy. I mean, I think that's a good point. I think there's sort of two markets. There's the markets where there is commercial hedging available, and that can be, I mean, that's typically in Africa, South Africa, Nigeria, sometimes, and some of the other markets for shorter term. But once you get out in the longer term, it is all really TCX is all that's out there. I know TCX still has a fair amount of capacity, and there is work being done, which we're involved in as well, that will increase capacity both for us and for TCX, that should be able to handle, you know, considerably more. But you know, I think that the efforts of, you know, GuarantCo, I mean, I think a lot more, you know, the problem has to be addressed at, you know, from all angles, and TCX can't be the only answer, but it is one that's going to grow. Per, I don't know if you want to say more about that too.
Well, I would add to that. I think that just to put a number out there, I think that any project which has a total debt funding component of 100 million can be relatively comfortably covered through either one or the other, or a combination of domestic funding sources, possibly with support from an international guarantor like GuarantCo, to get the banks interested or comfortable with project risk, but domestic funding sources in combination, to the extent that domestic funding sources fall short, with offshore funding hedged by TCX. I mentioned earlier that our single transaction limit is around $50 million. It could be a bit more. However, there are also ways of syndicating a hedge, meaning that we could bring in commercial players who might not be able to cover the full length of tenor that we could, but they could take a shorter end with a rollover idea, and together we could increase total capacity. And then it is of course clear that the mega projects, the 200 megawatt projects, the $500 million and upward type of projects, if they came to us today and they came to domestic banks, other than a country like Nigeria perhaps, or South Africa, the domestic funding, whether it comes from domestic sources or from hedged international lenders, is not there yet. And for situations like those, and we have seen that in the past, you could work with dual currency PPAs who have that would then, in the interest of mitigating off-taker risk, you could work with a local currency PPA to the extent that local currency resources are available, and with a dollar PPA to the extent that that's no longer the case. But for anything below $100 million or maybe $150 million, I don't think that constraints or local currency constraints are really an issue.
All right, thanks. Oh, sorry.
I was just going to say, I think the important point is, I mean, totally, you know, local currency is not going to provide all the solution everywhere, but neither is dollar debt either. So, I mean, for example, if you wanted to try and do a dollar deal now in Nigeria, you know, that's going to be very difficult at this moment in time. So unless you've sort of helped to build up the other options that could be available, including, say, Naira financing for such dollars, you know, you would be stuck at this moment in time. So I don't think anyone's saying that local currency is the complete solution for anything, but it should be one of the options available for people, and more needs to be done to support it. Is really what GuarantCo is there for.
All right, thanks for that. I have a kind of a bit of a broader question, and I think maybe Dirk, you can give an interesting angle on this as an industry practitioner. Please discuss whether there are any innovative ideas for dealing with the complexities of dealing with documentation requirements like ISDAs and CSAs, etc., when dealing with derivative hedging instruments.
Sorry, needed to unmute first. Oh dear. I'm not aware of any innovative initiatives. I know that it is a big issue, and I know that most commercial banks that would provide hedges in sub-Saharan Africa, if asked, it would quickly be established that the most descos, for example, in the space right now would not meet the minimum requirements they have before they even sign an ISTA with such a counterparty. Other than that, I think that goes a little bit outside of my area of expertise, and I don't know about any initiatives there.
Yeah, I can comment on that. Yeah, I mean, for MFX, I mean that obviously is one of our main missions is to take away that that issue. And since we a lot of times having a CSA, which is the credit support annex, which is what determines the collateral, can be the most complicated part. We eliminate that. From a credit standpoint, I think that is the challenge for for a DESCO or even an on-grid project to have the credit standing to be a counterparty, even collateralized with a bank. And that's sort of what all those structures that I was showing, which maybe were a little hard to follow in such a short time, but we're all basically designed to bring the credit of the most creditworthy partner in the transaction in support of getting the currency risk.
All right. Another question. Oh.
So I guess that's it.
Okay. I think one last question, just in view of time. Per, we got the point that local currency is not as expensive as it looks, or that US dollars are cheap either. However, interestingly, you kept mentioning the 15 to 17% as reasonable levels for local currency rates. In many instances, we sometimes receive quotations above 20%, especially when margin is included. Does it still make sense, or should projects take the chances with foreign currency risk? Can we reasonably advocate for someone to hedge itself at 30% for 15 years?
Well, the theory still holds, and we can show sort of analysis that we have done over such long periods of time, and it does still confirm the point that you're not necessarily cheaper or more expensive by taking one or the other option. We have done that analysis, and it just confirms the point. However, that is all fine and all dandy and great to say, but we understand that if you're a project developer and you're considering locking in a dollar structure at 5% or a local currency structure at 30%, that is a very daunting choice. So yeah, I think the theory still holds, but we also recognize that when hedge rates or borrowing rates are above, say way above 20 into 30% per annum levels, then the decision to lock those levels in for a very long period of time is a difficult thing to do, and it might then make much more sense to, for instance, take a variable rate. Or look at a structure whereby you can consider hedging at a later point in time. We recognize that there comes a point where pricing seems to be irrational and difficult to lock in for the longer period of time. But even in a situation like those, there are structures that you can look at to mitigate at least your risk, partial hedging, or as the other alternatives I mentioned, look at a floating rate option, so that you benefit from lower hedge rates when they come down. So there's different structures to look at in a scenario where indeed the fixed rate cost of hedging seems to be just too high to lock in for the long term.
All right, and with that, thank you, Per. I would like to round off this webinar. Thank you, Dirk, Per, Douglas, and Brian for your contribution and for your insight. There will be more about currency risk on the on the Unlocking Solar Capital Africa event, and TCX will be there, and Persistent Energy Capital will be there. So be sure to check it out. And thank you for being here.
Thanks.
Thank you, Evelyn.
Thanks everyone.
All right.